Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. This show gets you insight on everything mutual fund related. And today I'd like to talk about a very important component of your investment strategy when it comes to mutual funds. Now, we've established over the last few years in particular that going passive is actually beneficial for various reasons, particularly in certain pockets of equity mutual fund investing, particularly because of the advantage on the cost front. And that seems to have been embraced quite significantly both by investors as well as the mutual fund industry as a whole, where you saw most new products that were launched in 2024 were passive, either index funds or ETFs. And there are a lot of differentiated specific products in the passive space apart from the regular index funds that you've been used to perhaps. And some of these strategies have outperformed traditional actively managed funds by a very big margin. So today I'd like to talk first about a very interesting fact, which is that when everybody thinks of investing in passive for the first time, often they gravitate towards the most popular benchmark in the large cap category, which is the Nifty 50. Take a look at the last 1 year return for the Nifty 50. Let's pull up the chart, because till a few months back, that return was double digit and it ended up being just about 9% or thereabouts. But the Nifty Next 50, which is basically the next 50 stocks based on market capitalization, that has returned over 27%. So if you had actually gone beyond just the Nifty 50, and if you had been investing in the Nifty Next 50 as well, and taken advantage of those companies which often have a higher trajectory of growth in terms of price appreciation and generally knock on the doors and enter into the Nifty 50 eventually, then you would have earned more money. But I'd like to get our experts on to tell you what your strategy should be, and we'll also discuss why the Nifty Next 50 has done so well. Mohit Kang, who is a co-founder and chief executive officer of Moneyfront, and Amit Kukreja, who is the founder of AmitKukreja.com, are both joining me today. Gentlemen, thanks so much for taking the time, and wishing you and your families, your teams, a very happy 2025. Mohit, I'll come to you first. What do you make of this divergence? It's actually something that has occurred multiple times over the last several years, but I'm sure that you've analyzed it.
Thank you so much, Alex. Wishing you, your team, and all your viewers through your medium a very happy and prosperous 2025. So look, yeah, I think every passing year gives us some very interesting insights into the entire arena of fund management and the way indices have been doing and performing. And you rightly said that debate between active and passive has been everlasting since cows came home. So if we were to just look at these two main indices, which is Nifty 50 and Nifty Next 50, look, there were years preceding 2024 when Nifty 50 was actually outdoing Nifty Next 50 by a great margin. I think if I remember well, 2021 and 22 were fantastic years for Nifty 50 and not so much for Nifty Next 50. It's only last 2 years when Nifty Next 50 has kind of picked up steam. And prior to that, Alex, Nifty Next 50 was the one which was beating Nifty 50 hands down. So yes, it might suffice to say that these are more cyclical in nature, in the sense that every 1 or 2 years you see the baton passing to the other indice, and the Lagarde 50 typically, whether be the first 50 or the next 50, they kind of do some catch up. But just to analyze the last 12 months, I think the heavyweight names in the market, and the biggest being Reliance per se. And if you were to talk of other companies like ITC, HUL, HDFC Bank, these were all low single digit returns. And these have a very large bearing on Nifty 50, Alex. Compared to that, if you see the main constituents of Nifty Next 50, you will see names like Hindustan Aeronautics, Avenue Supermarkets, Varun Beverages, right? IRFC. So those are stocks which have done exceedingly well. And that's kind of led to the overall outperformance of Nifty Next 50 by a huge, huge margin. But if you see Nifty 100, on an aggregate level, the returns are low, say double digit returns. My senses should be in the range of around 12, 14 odd percent for the year put together, right? So the composite number is fairly muted. Nifty Next 50 has clearly outperformed by virtue of few good stocks doing exceedingly well. Zomato also is one of the big names out there which did exceedingly well for the year, and that's kind of marked. But my sense is these are every 1 or 2 years you see the baton passing to the other one in the two. So there is not a clear winner over many years put together.
So I sent this topic to you before the show, of course, and Amit, you have some interesting points to make about the earnings growth, which is possibly the reason why what Mohit has pointed out has actually occurred. You want to take us through that?
Yeah, sure. Thanks, Alex, and Happy New Year to you all as well. So I think one of the biggest factor why Nifty Next 50 has outperformed Nifty 50 is the whole momentum. The whole momentum which has been built up in that index by the companies which are doing well and they're financially well fueled to take the companies to the next orbit has actually pushed the overall index average. And because they are also earning well and because there is a momentum in their stocks, we see that graph going in a much steeper fashion compared to Nifty 50. I think also there is the sentiment in the market. When there is a bearish market, you tend to consolidate and stay in a more conservative fashion of investing in the companies which are more stable, reliable, rather than companies which are growth oriented. But in last 1.5 years, we have seen the sentiment is become extremely bullish. People are pouring money in mid cap, small cap, and of course, some of those companies, the mid cap companies, few of them have become part of the Nifty Next 50, and we can see that mid cap and the growth companies' performance impacting positively the performance of the overall Nifty Next 50 index. I think the third factor is that the composition of the index in terms of sectors being covered, we have a much wider range of sectors which are in Nifty Next 50 compared to Nifty 50, which is predominantly financial services and IT, or not as wide a spectrum of sectors as we have in Nifty Next 50. So broadly, these are 3 or 4 factors which have contributed towards Nifty Next 50 doing much better than Nifty 50.
Now, when it comes to actual strategy, I know a lot of people have spoken about and we also spoke about the outperformance of actively managed fund managers in 2024. But as we've established many times on this program, there are periods of outperformance and underperformance, and purely on the cost basis and taking into account all of the factors, there is a very strong case to be made to have your passive investments in your large cap space. But I want you to tell me what you think is the ideal strategy. I'll start with you, Mohit. Based on what we've just discussed, just having the Nifty 50 is not a good idea. So if you've only been investing in the Nifty 50 and you want to add, say, a Nifty Next 50, should you move whole hog? Should you make incremental investments? And what is the ideal strategy here?
Look, okay, so Alex, it's never a good strategy to be a one-trick pony, whether be in markets or in anything, right? So if you're just doing Nifty 50, I don't think so that's a prudent idea. Unless you are just wanting to be an extremely simplified investor and wanting to keep doing it for 30, 40 years, where I think long-term averages will kind of tend towards equilibrium. But having a Nifty Next 50 along with some active and a mix of factor-based strategies, both on the mid and small cap arena, would be a potent combination. So I would reckon an investor should always have 2 or 3 passive strategies, out of which one pure play passive, which could be a Nifty 50 and a Nifty Next 50, and then a couple of factor-based strategies, one a momentum-based strategy, and second perhaps a quality or a alpha, depending on what the investor's mindset and outlook and the growth thesis is. Right. So out of these, you need to have some bit out there, and then maybe 2 or 3 active strategies in the portfolio, and a combined impact being like 6 to 7 odd schemes in a portfolio gives you a holistic market cap diversification and an investing style diversification, along with a proper mix of active and passive strategies. So my sense is one needs to have that. To answer your second part, which is whether one should go all hog or should kind of stagger it out. Look, I would reckon India still has to kind of justify, the markets have to justify earnings growth. We've had a low single digit or perhaps around 9% kind of EPS growth last year. So my sense is we need to see what comes out in the budget. We need to see how the geopolitical thing is shaping up, how's the world changing changing post-Trump, and we also need to see the start of rate reversal cycle in India, right? So there are many factors that play out here. So I would say a 6-month STP kind of a strategy is perhaps the best way to kind of enter into 2025, and not a full lump sum kind of a thing. But yes, having a proper prudent mix of active, passive, factor-based passive, and a good combination of these is the right thing to do.
A quick follow-up, and so that I've taken your point where you're suggesting that you shouldn't allow just incremental flows into the ones that you've suggested. You should take an active hand in moving some of your assets from just the Nifty 50 into the ones that you've suggested. But what is the kind of breakup between active and passive that you would suggest is the ideal strategy?
That's to me, Alex.
Yes, to you. Just a follow-up, and then I'll go to Amit.
Look, personally, Alex, I'm more a passive guy. Honestly, my personal portfolio, with all disclaimers being here, would be almost 80-85% passive. Incremental flow is all passive. However, having said which, I would still see an investor going 50-50 active passive, or at best 60 in favor of passive and 40 in favor of active.
That's quite the call. All right. Amit, I'm coming to you. What's the view here? Same question that I gave to Mohit, where he's given me a pretty aggressive call on passive. What's your opinion?
So I am not as aggressive as Mohit is. I am more about capital protection, more about a game of defense, because I strongly believe wealth management is a game of defense. So we need to protect first, have tax efficiency, and then create alpha. So in my view, we do not have enough data in the passive space to be able to move 100% passive in my client's portfolio. The data is still building up. When I compare the data, the only passive data that I could gather other than the index was momentum, Nifty 200 momentum 30, because of a particular fund house who have a product which has been there for 3 years and has delivered a decent return. That has convinced me that it's one of the significant pillars of a client's portfolio. Until I get data on the table, I will not be comfortable adopting this strategy, although theoretically it makes a lot more sense that Mohit was saying in terms of reduced expense ratio, in terms of quality, in terms of keeping it very close to the index performance or even outperform the index. But we have seen that the active fund managers have done a very good job of creating alpha in the mutual fund portfolios. And there are still some top performing funds in every category, including large cap, where I've completely made a call about passive, although, but on the mid cap, small cap, or multi cap space, I'm still active. And I would wait for some more data to be collated and put together, at least for a 3-year period, before I make that call of how much active and how much passive I'm going for a client.
A fair point, but then at this juncture, with the information that you currently have, what, according to you, is the ideal mix at this juncture? And if you are to play that passive strategy as part of your portfolio, which a lot of people do advise, where do you go, in your opinion?
In my opinion, I would not cross 40% as a passive holdings of mutual fund schemes. 60% active. It can be lesser than 40 for passive, but definitely not above 40 for passive.
Okay. And that passive, where would you put it right now, Amit?
That'll be index, Nifty Next50, and Nifty 200 momentum 30. Combination of these three based on the risk tolerance of the investor.
Okay. So you've got two very interesting opinions at this juncture, and both have valid points. Mohit, I'll come to you as with a follow-up on this, right? So one of the drawbacks of the passive strategy, it has been pointed out, is the inability of that strategy to protect downside, as well as arguably, hypothetically, an active fund manager should be able to do. It's not always possible, which is why you see significant underperformance in certain cases of an active fund manager. I think to a large extent we've seen this play out in the small cap category in 2024 itself, where a large number of active fund managers have failed to beat the benchmark. What would you say about the ability or inability in this case for downside protection?
Look, Alex, I think it works both ways. It works both ways in the sense that if you are really combining your passives well, right? And by passives, I am including the factor-based passives out here. If you are combining, let's say if you just play momentum, honestly, it's a fairly aggressive strategy, and it's a highly volatile and highly risky strategy. So your downside is equally high in a falling market on those kind of strategies. But let's say if you were to play a low volatility fund, or if you were to play a quality index per se, right? Those aren't very aggressive strategies in the passive style. So they will give you enough and more downside protection compared to active funds, right? Obviously, when a market falls holistically, I think everything will see some correction from the peak levels. But combining a low vol strategy, combining or even on the passive fund having, let's say, a value based strategy, right, or having a quality strategy, these things can give you good amount of downside protection and good amount of risk adjusted returns if you're looking for that. Only for investors who are aggressively chasing alpha, then we kind of go ahead and suggest a momentum strategy. It is not for everyone. It is obviously basis risk appetite and basis a client's profile and investor need. So obviously it's not a lock stock and barrel go out and buy kind of a strategy. But yeah, having a passive Nifty 50 or a Nifty 50, Nifty Next 50 index, to my mind, is a no-brainer kind of a thing. You got to believe in the top 100 companies of the country, and if you really want to be very simplistic about your investment philosophy for let's say decades put together, then you just buy and forget these kind of strategies and keep building up your portfolios out there. So to my mind, I don't think so any harm there. Active managers can give you downside protection at times, but can also blow up at times if they invest in wrong stocks. So my sense is it works either ways on the active side. A passive is a passive, so it will do what the index does. So to my mind, I'm happy to take that.
Okay. Uh, okay, I'll come back to you on this next one, but I want Amit's view on it as well, because you're seeing a few quant funds coming in which combine a number of these factors. And I looked at the SBI quant fund, which is 4 factors, right? And you're talking about at any given point of time, and they've pointed out it's of course a new fund, and so we'll have to see how it performs. But just in terms of the theory, you're talking about combining a number of these factors that you've both spoken about and not having an orientation towards just one at any given point of time. You're talking about a combination which shifts based on what the model suggests. So would you combine that as well into this, Amit?
So, Alex, my answer is very simple. Either the investor is a risk taker, or an investor is a balanced risk profile, or he's a conservative risk profile. Now, if he's a risk taker, there is enough on the table in terms of opportunities of adding mutual fund investments that have high risk factor. This could be momentum strategies, this could be mid cap, small cap space, even in passive, or this could be a multi cap, flexi cap space. When I do have enough choices which have proven the records of performance, I would not start the new option on the table until I'm convinced with the data, and the data has to speak about not just the upside but also the downside of the market. We are only seeing the upside of the market data at the moment for the last 3 years. We need to wait and see how these things are performing during the downside. So as of now, I would stay away from these, even though they look a very fancy theoretical combinations. If somebody has surplus money and want to dabble in it and give it a shot, I'm happy to invest and learn from their mistakes as well. But I personally see financial planning is a very serious business of helping clients reach their goals faster. So we would rather take a time-tested approach and help them reach the goal faster than experiment with new things until the data comes through.
Okay. And how much data would you need to see, Amit, in order to take that call?
Very simple. Either the market has shown the upside and the downside cycle, or minimum 3 years. Now, if I'm lucky enough to see the upside but downside within 18 months, fantastic. Then I have enough data to be convinced to add them or not to add them. If my market is only going in one direction in last 3 years, then I'll wait until the market turns around and shows us the performance numbers for the downside also.
I just want to confirm, Mohit, I'm reading off the screen here. You've talked about Nifty 50, Nifty Next 50, Nifty Alpha 50, 200 Momentum 50 and Mid Cap 150, right? These are the passive strategies that you like, and quite a few of these do have that time frame that enough time frame to judge how these have worked, right?
Definitely, Alex. I think, look, the funds have not been in place beyond 3 year kind of a thing, but the strategies and the indices for most of these factors have been there for over 5 years. In fact, 7 to 10 years for momentum, alpha, value, even quality. To my mind, is almost a good 7 year old index, right? So the strategies have been in vogue globally. These have been time tested, Alex. So with a disclaimer out here that in India, perhaps these are just scattering up the fancy of investors, but globally, since whatever last 2 3 odd decades, I think factor based investing is one of the most proven strategies and one of the most successful strategies. In fact, the global allocation of funds has shifted and tilted in favor of passives by a margin of around 54 to 46. So 54% is now all passive strategies, and the bulk of those is all factor based strategies now, right? So globally, I think it's got proven enough. India, the track record is there. The funds were not in place, which have also come in place for last 3 years. And my sense is it's a matter of time, about 2 or 3 years, when perhaps market at large might start sniffing more opportunities.
So we've gotten two very stark views here, or not necessarily very stark views, but differential opinions here in terms of how you should approach your passive strategies. And I would be very keen to find out what you, the viewer, thinks about this. So if you've got specific questions about what both Mohit and Amit have said, they've both got their merits. So let us know what you think and what you think you will employ based on the advice that they have dispensed. Let's jump into the questions that you've already sent in. And there are quite a few questions that I have in front of me today. The first one's from Dev. He's 35 years old. He's looking to invest a lump sum of 1 crore in a staggered way in the Kotak Debt Hybrid Fund, in the Quant Multi-Asset Fund, in the Kotak Equity Opportunities Fund, and Tata Small Cap Fund, breaking it up into all of these. Is this the right kind of blend of stocks? And I know, Mohit, that you've just pointed out in your opinion that there should be a blend of passive and active. So why don't you talk to him about how he should do this? But he specified that his time frame is 4 to 7 years, which is not a very large time frame.
So look, I think one thing which I see missing in the portfolio, Alex, is a proper large cap allocation. I would personally strictly advise any and every investor to have bulk of the monies in large cap and pure large cap plays. So Kotak Equity Opportunities is a large plus mid cap kind of a thing, but it's not a true large cap thing. So in the large cap basket, perhaps they might do well to have a Pru Nifty 50 index fund or a pure Nifty 50 index fund, and that should, I think, give him a good balance of the overall perspective. Otherwise, I think a multi-asset and a small cap fund is fairly good in the portfolio, and hybrid, I'm sure he has his reasons. So multi-asset and hybrid, both are identical in the sense that they are not 100% equity, right? So both are more balanced plays, but I'm sure he has assessed his risk profile with a time horizon of 7 years. Perhaps he might just tilt them still more towards or more in favor of equity.
Okay. All right. SBS Manian, who's 63 years old and has not given us any more information than that, has said that he would want to invest in one mid-cap and one small-cap fund. I know, Amit, that I'm not asking you to give us recommendations or give SBS Manian any recommendations because we don't know anything more about his risk profile, etc. But in your opinion, which 2 or 3 mid-cap funds have a proven track record, small-cap funds have a proven track record, so that we can narrow it for him to look up and get advice on?
Yeah, sure. So Alex, my fundamental assumption is that Mr. Manian has the risk tolerance, and this is a surplus money. He can take the risk with this investment. In terms of mid-cap and small-cap, I think one of the few top performers are HDFC Mid-Cap Opportunities Fund and Kotak Emerging Equity Fund. He can review and study both the funds in mid-cap space. In the small-cap space, I would give names like Nippon India Small Cap Fund, which has been a terrific performer for last several years, and also Tata Small Cap Fund. He can explore these two as well and pick the ones that suits his interest and his risk tolerance.
Okay. Am I wrong if I remember correctly, Tata Small Cap had stopped lump sums, had it restarted again? Amit?
I need to check. I need to check. I'm not sure about that, Alex. Sorry.
Okay. Mohit, just want to check so that we're absolutely clear. I saw you
you're
nodding
right.
your head.
Yes, Chandra Prakash Parriyar, the fund
Yeah.
manager, I think he gave a very brave call at around 5,500 odd crores to close the small cap
Yeah.
fund when the others in the industry at around 20,000-30,000 odd crores were still collecting money,
Yeah.
and they have resumed subscriptions recently, if I'm not.
Okay, so they've resumed subscription. Sorry, so I'm a little behind in terms of that. But then, so do watch for whether or not lump sums are
On
allowed.
the resumption of subscription, I'll have to check, but they definitely did close, and for a very
Yeah.
long period they were closed.
Yeah, so do check on that, Mr. Manian, if you are listening in, and hopefully you are. Manoj Tonk, who's 50 years old, wants to invest 10 lakh rupees. He's asking whether he should do this through an SIP route or should he go for lump sum. The third option, of course, is the STP route. And what funds can he invest in? He has a 10-year time horizon and he's looking for a higher return than the Nifty 50. So, Mohit, a combination, of course.
Yeah, Alex, I'll go with the third route, which is an STP route right now. I think we've already highlighted in the first half of this show, there are too many variables at play for the first half of the year. So perhaps going with an STP route for around 6 to 9 months would be a preferred thing. Combination when he's expecting higher than Nifty returns, honestly, over a 10-year time frame to beat Nifty in itself would be a mammoth task, and one should be pretty satisfied and happy if you really do a Nifty kind of a return. But if you want to go for that combination, then yes, you have to go with a slightly more aggressive mix of mid and large caps predominantly, though I'll still go with a small dash of large cap in the portfolio. So I'll go with a 3 lakhs in large cap, 4 lakh in mid cap, and 4 lakh in small cap. Again, as I said, a combination of active and passive strategies put together should suffice well.
And systematic transfer plans, that's what we were talking about. In case you're hearing this term for the first time, this is where you will deploy funds into a liquid fund or any other short-term debt fund of a particular mutual fund house and choose the STP route or systematic transfer plan route. And what Mohit is suggesting is you can look at deploying that over a 6 to 9 month time frame. So over that period, you will have a systematic transfer from one scheme to the other scheme of the same fund house. Mohit, Amit, thank you so much for joining in and for an engaging conversation. I enjoyed it and I'm hoping that my viewers found it interesting as well.
Thank you, Alex.
All right, that brings us to the end, as I said, of this edition of the Mutual Fund Show. Thanks so much for watching. Do stay tuned. Lots more coming up on NDTV Profit.